MCX IPF presents Simplifying Commodities, Futures, Options and Indices.
Crude oil options are the most widely traded energy derivatives on NYMEX and have been clocking record volumes in India too. Given the volatility in prices due to Omicron, the new variant of COVID and supply release from the consumer nations. So more investors are including crude options in their hedge and portfolios. Let me take you through on how to participate in crude options in India. First up, let's get to the contract specifications. Crude options are on crude oil futures, so it's derivatives on derivatives. It's options on futures. As per regulatory norms, Europe-style commodity options are available in India. Commodity options on exercise devolve into the underlying futures contract. The European options are cash settled, meaning that once the options are exercised, the option holder receives the positive payoff in cash. The biggest advantage in trading options is that the most the option holder can lose is the premium paid, and you exercise the option only when the prices are favorable for you. So for crude, the lot size is 100 barrels. The contract starts the day after the expiry of the underlying futures contract, and expiry date is set 2 days before the expiry of the underlying futures contract. The contract is quoted in rupees per barrel with the strike price interval at 50 rupees per barrel. At the expiry, the long call positions devolve into long futures, the long put into short positions, and if you look at the short calls, that goes into short futures, and in case of short put, that goes into the long futures underlying contracts. Now let's understand this with the way of an example. On 1st of December, A enters a long call on the Feb 2022 options contract. The current price is 4,950. At 5,100 rupees is where the strike price is. The option cost for this is 100 rupees, and because the contract size is 100 barrels, so your total give is 10,000 rupees. If the price rises to 5,125 on expiration, the option will expire and then it would be worth 175 rupees per share, and that would come to 17,500 rupees per contract. So the earnings from this trade would be 17,500 minus 10,000, because 10,000 is what you paid as a premium. Your earning on this contract is 7,500 per contract.
MCX IPF presents Simplifying Commodities, Futures, Options and Indices.
Brought to you by MCX IPF.